Welcome back to the deep dive. If you or someone you know gets Social Security, you've probably grappled with what feels like the trickiest tax question out there for retirees.
Absolutely. How much of my benefit check is actually taxable? Is there even a straightforward way to figure it out without, calling up an accountant every time?
It really does feel like a puzzle sometimes.
It can,
Okay.
but the path is, well, it's actually laid out pretty clearly by the IRS. So today, we're aiming to give you the definitive shortcut.
Okay.
We're pulling directly from their playbook, specifically Publication 915, looking at the rules for 2024 returns.
Right.
And just to be super clear on scope, we're focused entirely on Social Security retirement, survivor, and disability benefits, and also those equivalent Tier 1 railroad retirement benefits, which we'll just call SSE to keep it simple.
Got it. So not things like SSI.
Exactly. We are specifically not talking about supplemental security income or SSI payments today. Different rules apply there.
Okay. So our mission then is to really cut through the confusion around the core math, right? Forget all the noise for a minute. This whole tax thing, it boils down to one key comparison. Does your income cross a specific base amount threshold? That threshold depends on your filing status.
That's the crux of it.
Yeah.
If we can unlock that comparison for you, we could save you, well, probably hours of headache and complexity.
Okay, let's dive into that. The IRS uses this specific calculation as like a gateway test to see if you even need to worry about your benefits being taxed at all. What's the fundamental formula we need to run first?
Right. So this calculation is often called your combined income. That's the key figure you compare against your base amount. It's calculated in two main steps.
Okay, lay them out for us, because I know this is where people can easily, trip up. It's not just your AGI, is it?
No, definitely not. Far from it, actually. Step one.
Are you sure?
You take exactly half 50% of your total net benefits.
Net benefits. Where do I find that?
That number comes straight from Box 5 of your SSA 199 or RRB 1099 form. Very important, Box 5.
Okay, box 5, half of that. What's step 2?
Step 2. You add all your other income sources to that half benefit amount. And here's the kicker for a lot of taxpayers. That other income explicitly includes things like tax-exempt interest.
Wait, hang on. So the interest from my municipal bonds, which is supposed to be tax-free, the IRS pulls that back into this calculation just to see if they can tax my Social Security.
That's exactly right. It feels a bit counterintuitive, maybe, but that's the rule. They use a very specific, broad definition of combined income for this test.
Wow. Okay. That's clever, I guess. Bit sneaky, maybe.
Well, it means you have to look beyond just your standard taxable income lines on your return. And another point here, when you're figuring out that other income piece,
Yes.
you're specifically told not to reduce it by certain other, usually minor statutory exclusions, things like interest from qualified U.S. savings bonds or certain employer-provided adoption benefits or foreign earned income exclusions.
So they really want a broad measure of your available funds.
Exactly. The takeaway is that this combined income calculation is designed to be very inclusive. It casts a wide net.
Okay. That definitely raises the stakes. So let's get to the gates themselves. What are these base amounts for 2024? The actual dollar thresholds that determine if you cross into taxable territory?
Right. These are crucial numbers, and they depend entirely on your filing status.
Okay.
First, if you're single, head of household, or a qualifying surviving spouse, your base amount is $25,000.
$25,000, okay.
Second, if you're married filing jointly, MFJ, which is very common, the base amount is higher, it's $32,000.
$32,000 for joint filers. Makes sense.
Third, there's a specific case for married filing separately, MFS. If you filed separately, but you lived apart from your spouse for the entire year, all of 2024,
Lived apart all year.
then you actually get the same $25,000 threshold as single filers.
Okay, interesting.
And finally, here's the big one, the real red flag situation. If you are MFS married filing separately and you lived with your spouse at any time during 2024,
Even for a day.
even for one day, your base amount is $0.
$0.
$0. Wow. So if you're married, live together, but file separately, you're automatically into the taxable calculation.
Yeah.
Is there any good reason someone would do that? Or is that basically the IRS saying file jointly if you get benefits?
It's a massive disincentive for filing separately when living together. I mean, in almost every case, that zero threshold is going to push the filer immediately towards potentially having their benefits taxed, and likely at the higher rate, too.
Okay.
Which actually brings us neatly to the next logical step. the taxation tiers.
Right. So, okay, let's say we did the math. Our combined income is over our base amount. We know at least some of our benefits are potentially taxable now.
Mm-hmm.
The next question is how much? I know there's this step up. It starts where maybe up to 50% of your benefits could be taxed, but then it can jump potentially up to 85% being taxed. How do we know which tier we land in?
Yeah, that jump really depends on how far above that base amount your combined income calculation falls. Generally speaking, if you're just a little bit over that threshold, just squeaked by.
Right. Then usually up to 50% of your benefits will end up being taxable. That's the first tier.
Okay, 50%.
Right.
But then there's that higher rate, the 85% rule. That seems like it would affect higher earners more. Where exactly does that kick in?
It kicks in when your combined income, that same calculation we did before, passes a second higher threshold.
Another threshold.
Yep. For a single filer or head of household or qualifying surviving spouse, if your combined income is more than $34,000, you start entering that potential 85% territory.
34,000. Okay. What about for joint filers?
For those married filing jointly, that second tier threshold is $44,000.
44,000. Okay, let's just put that into perspective for a second. If I'm single and my combined income is, say, $33,000, only up to 50% of my benefits might be taxed. But if I earn just an extra, like $1,001, landing me at $34,001, suddenly I've jumped into this higher tier where up to 85% of the same benefits could become taxable income. That seems like a small income bump, causing a potentially much bigger tax hit on the benefits.
That's exactly it. It creates a kind of cliff edge, that $34,000 or $44,000 threshold for the 85% rule.
Yeah.
And don't forget that other scenario we mentioned earlier, the married filing separately one.
The zero base amount people.
Right. If you're MFS and lived with your spouse at any time during 2024, you don't even need to hit the 34K or 44K mark. You're immediately subject to the rules where up to 85% of your benefits could be taxed.
Wow. Okay. So that MFS status when living together is like a double whammy.
Right.
Zero base amount and straight into the highest potential tax tier.
Pretty much. Strongly discouraged by the tax code structure.
Definitely noted. Okay, before we move on from these tiers, I want to circle back to something. What if someone does the calculation, figures out their combined income, and finds they're actually below their base amount, say, below 25K single or 32K joint? They might think, great, none of my benefits are taxable. I don't even need to file a tax return. Is that necessarily true?
That's a really important point and potentially a big misconception. No, it's not necessarily true.
Okay.
Even if that calculation shows $0 of your Social Security is taxable, you might still have to file a return.
Why is that?
Because you still need to check the regular filing requirements. You have to look at your other taxable gross income, things like pensions, maybe wages if you're still working part-time, dividends, interest, and see if that income exceeds the minimum filing requirement for your age and filing status. The Social Security calculation doesn't override the basic need to file if your other income is high enough.
Got it. So 2 separate checks needed there. Good clarification.
Yep.
All right, now that we've got the math principles down, let's talk about the actual document you get in the mail, that SSA 10099 form, or the RRB 1099 for railroad benefits. These forms are really the starting point, right? They give us the raw numbers for our calculations.
They absolutely are. And thankfully, the forms sort of distill it down for the main calculation we've been talking about. It really centers on Box 5.
Box 5 again.
Yep. But to really understand Box 5, it helps to know what feeds into it.
Yeah.
So on the form, you'll see Box 3, which shows your gross benefits paid during the year. That's the total amount they sent out.
Okay, Box 3 is the gross.
Then there's Box 4. This lists any benefits repaid to the SSA or the RRB during the year. This could be because maybe they overpaid you in a previous year and you paid it back this year.
Right, repayments in Box 4.
And then Box 5 is simply the net figure. Box 3 minus Box 4. Gross benefits paid minus benefits repaid. That Box 5 number is the one you use for the 1/2 of benefits, part of the combined income calculation.
Okay, that makes sense. Net benefits in Box 5 is the key input. What about situations where maybe one person gets a check, but it includes benefits for multiple people? Like, say, a parent receives a single payment that covers their own retirement benefit and also benefits for their dependent child. Who pays the tax on what?
Yeah, that comes up. The rule here is quite clear. The benefits are considered income and potentially taxable to the person who has the legal right to receive them.
The legal right, not necessarily who cashes the check.
Exactly. So in your example, the parent takes the check, but they only include their portion of the benefits in their combined income calculation for their tax return.
Okay.
The child's portion of the benefit is considered the child's income. That amount needs to be added to any other income the child might have.
Like from summer job or investments?
Precisely. And then the child's total income is tested against the child's own base amount threshold, usually this single filer $25,000 one, to see if their benefits are taxable, potentially requiring the child to file their own return.
So you can't just lump it all onto the parent's return. It follows the legal entitlement.
Correct. Liability follows entitlement, not just who handles the deposit.
Makes sense. Now, if we do figure out that, yes, some of our benefits are going to be taxable, what can we do proactively so we don't get hit with a huge tax bill in April?
Good question. You basically have two main options to manage that tax liability throughout the year. First, you can choose to have federal income tax withheld directly from your Social Security or SSN payments. You do this by filling out Form W-4V, voluntary withholding request, and sending it to the SSA or RRB.
So just like withholding from a regular paycheck.
Exactly like that.
Yeah.
You choose a percentage rate, 7%, 10%, 12%, or 22%. The second option, if you don't withholding or maybe it's not enough, is that you likely need to make estimated tax payments yourself throughout the year. You'd use Form 1040-ES to calculate and pay those, usually quarterly.
To avoid those underpayment penalties later.
Precisely. You need to stay ahead of the liability.
Okay. One last little nuance on the forms about that repayment box, box 4. What if I had to repay a bunch of benefits? Maybe there was a big overpayment discovered from a prior year, and the amount I repaid this year, box 4, is actually more than the gross benefits I received this year, box 3. That would make box 5 negative, wouldn't it?
Yes, it would. And that specific scenario is actually the most straightforward, favorable outcome for a taxpayer dealing with a large repayment.
How so?
If your total repayments in box 4 are more than your gross benefits in box 3, resulting in a negative number or 0 in box 5. The rule is simple. None of your Social Security benefits are taxable for that year.
0 tax liability from Social Security for that year.
Correct. The large repayment effectively wipes out any potential taxability on the benefits received in that specific year.
Okay, moving beyond this sort of standard annual income comparison, there are a couple of, let's call them special cases or edge cases we should touch on. These involve international residency and also those sometimes confusing retroactive lump sum payments. Both have specific rules and potential exceptions.
Right. International situations often bring tax treaties into play, which can override the normal U.S. rules. Let's start with U.S. citizens who live abroad. Are there places where a U.S. citizen can live and actually be exempt from U.S. tax on their Social Security or SSE benefits?
Yes, there are, thanks to specific tax treaties the U.S. has with certain countries. If you're a U.S. citizen and a resident of one of these treaty countries, your U.S. Social Security benefits are generally exempt from U.S. tax. Which countries are we talking about?
The key ones include Canada, Egypt, Germany, Ireland, Israel, Italy, though there's a catch with Italy, Romania, and the United Kingdom.
Okay, that's a decent list. Canada, UK, Germany, those are popular spots. What's the catch with Italy?
For the Italy exemption to apply to a U.S. citizen, you generally must also be a citizen of Italy.
Right.
A dual citizenship requirement there.
Ah, interesting nuance. Okay, so that's a pretty significant benefit for U.S. citizens living in, say, Canada or Ireland. What about the flip side? Non-resident aliens, NRAs, receiving U.S. Social Security, how are they treated? Does it change dramatically?
Oh, it changes radically. The default rule for an NRA receiving U.S. Social Security, if no treaty applies, is actually quite harsh.
How harsh?
The default is that 85% of their benefits are subject to a flat 30% U.S. tax withholding.
Wow, 30% tax on 85% of the benefits. That's substantial.
It is. However, those same tax treaties we just listed often come to the rescue here, too. Many of them exempt residents of those countries, like Canada, Germany, UK, Ireland, Israel, Italy, Romania, Egypt, from this U.S. tax entirely.
So the treaties work both ways, often.
Often, yes. And interestingly, for NRAs, Japan is also on that list of treaty-exempt countries.
Wait, so let me get this straight. If I'm an NRA living in Japan, my U.S. Social Security is exempt from U.S. tax because of the treaty.
Correct.
But if I'm a U.S. citizen living in Japan, Japan wasn't on the list you gave for U.S. citizens abroad, so my benefits would still be subject to U.S. tax under the normal rules.
That's absolutely correct. It really highlights how specific and, frankly, sometimes asymmetrical these treaty provisions can be. Residency and citizenship status matter immensely.
Fascinating. Any other treaty quirks for NRAs?
Just one more worth noting. Switzerland, their treaty doesn't provide a full exemption, but it sets a specific lower flat tax rate of 15% on the benefit amount instead of that default 30%.
Okay, good to know. Now let's tackle that lump sum issue. This happens, right? Someone gets approved for benefits, maybe disability, and they receive a large check this year that includes retroactive payments for several past years.
What?
If they just dump that entire lump sum into their current year's income calculation, it could totally blow past those thresholds, right? That $34,000 or $44,000 limit we talked about. It could push them into the 85% tax tier just because of payments meant for earlier lower income years. That seems unfair.
It does seem unfair, and that's precisely why the IRS provides what's called the lump sum election method. It's designed to prevent that exact tax trap.
Okay, how does it work?
So the basic rule is that you include the entire lump sum, including the parts for earlier years,
Yeah.
in your current year's income calculation, unless you choose to use this special election.
And the election lets you.
It allows you to potentially recalculate the taxable portion of the lump sum payment, specifically the parts attributable to earlier years, by using the income figures and filing status from those earlier years.
So you can see if taxing it back in the year it should have been paid results in less tax overall.
Exactly. You essentially do a what-if calculation. If using the prior year's income data results in a lower amount of your benefits being taxed overall compared to just lumping it all into the current year, you can use that more favorable result.
That sounds like it could be complicated, maybe involving looking up old tax info, but potentially very beneficial.
It definitely involves more work. You typically use worksheets 2, 3, and 4 in that publication 915 to figure it out. But yes, it can save significant tax dollars.
And how do you tell the IRS you're using this special method? Is there a box to check or something?
Yep. If you calculate it out and decide to use the lump sum election method because it saves you tax, you need to specifically signal that choice on your tax return, Form 1040 or 1042-R. There's usually a checkbox right near where you report your Social Security benefits, on line 6C typically, indicating you made this election.
Okay, so it's an optional calculation, requires some effort, but definitely something to look into if you get a big retroactive payment. #PAG outro. Wow, we really did cover a lot of ground there. But, distilling it down, the main takeaway still feels like it circles back to the beginning, doesn't it?
I think so.
The absolute key to figuring out your tax liability on these benefits is, first, correctly calculating that combined income figure.
Including that potentially surprising tax-exempt interest.
Right. And second, knowing the specific base amount threshold, that $25,000 or $32,000 gate that applies to your filing status, that seems to be the most critical number in this whole process.
Really is the foundation. Get that comparison right, and you're halfway there. And, just to leave you with maybe one final, slightly more complex thought to mull over, something related to those repayments we discussed.
Go on.
We talked about repayments reducing your Box 5 net benefits. But what if you had to repay a really significant amount of benefits this year, say an amount over $3,000, and these were benefits that you had actually received and included in your income and paid tax on in a prior year?
Okay. So I paid tax on money back then, and now I'm having to give back more than $3,000 of it this year. That feels like I should get some kind of bigger tax relief now.
Exactly. And the IRS agrees. If that repayment of previously taxed income is more than $3,000, the rules give you a choice for how to get your tax relief in the current year. This is under a specific part of the tax code, section 1341, if you want to look it up.
A choice. What are the options?
You have two ways to calculate the tax benefit from that repayment. Option 1, you can simply take the repayment amount as an itemized deduction on your current year Schedule A, assuming you itemize.
Okay, straightforward deduction. What's option 2?
Option 2 is generally more complex, but potentially better. You can recalculate your tax for the prior year, the year you originally included the income, as if you had never received that amount you just repaid. You figure out how much less tax you would have paid back then.
Right.
And then you claim that difference as a tax credit on your current year's return.
Credit versus a deduction. So I'd have to basically run the numbers both ways, figure out the tax savings from the deduction method, compare it to the tax savings from the credit method.
Exactly. You calculate it both ways, and then you choose whichever method results in less tax owed for the current year.
That requires looking back at old returns, doing potentially complex calculations. But a tax credit is often more valuable than a deduction, especially if it's dollar for dollar.
It often is. It's a very specific relief provision, really designed to make sure taxpayers aren't unfairly penalized by large repayments of income they already paid tax on. definitely something worth investigating further if you ever find yourself in that specific over $3,000 repayment situation.
That's a fantastic final point, a real deep dive into a potentially valuable nuance. Well, hopefully this whole discussion provides a much clearer roadmap for navigating the taxability of Social Security benefits this year. Thanks for breaking it down.
My pleasure. The goal is always to be well informed.
Indeed. Until next time on the Deep